He speculated, he invested, and he conquered. That is one way to describe Michael Burry, a legend in his own right. Although Michael Burry is most remembered as the protagonist in The Big Short, he was already well known in the value investing community. He took a break after his enormous win betting against the mortgage market, but later reopened a fund. He often has a lot of turnovers, and this quarter, which ended March 31st, 2022, was no different. He frequently owned inexpensive stores, and the results ranged from bankruptcy to improbable success, like GameStop. Michael Burry's recent position has taken the world by storm. Watch the video till the end to learn about the doomsday-like situation the economy is in. Make sure you hit the like button. Don't forget to share the video, as it helps to spread the word better. And finally, subscribe to our channel. He predicted inflation in 2021. Michael Burry initially issued a warning about excessive inflation due to the Fed's enormous printing of money in February of last year. He used hashtags like "doomed to repeat" and "prepare for inflation" in his tweets, and criticized the U.S. government and the Federal Reserve for their trillion-dollar economic stimulus package. He was the contrarian at that time, since everything appeared to be going great. Even though the Fed was printing money, inflation remained low. The most recent information indicated an annual inflation rate of just 1.7%. It fell below the Fed's desired level. But in classic Burry fashion, the man was just early. Fast forward 12 months and we're now running at a red-hot inflation rate of 8.6%. A month ago, Burry tweeted, "Habitually be 1 or 2 years early on everything, and you too can attain broken clock status." It was in response to Elon Musk's tweet calling Burry a broken clock. Where are we headed according to Burry? In the past few weeks, Michael Burry has not only done victory laps, but also explained in great detail how he predicted that the subsequent market downturn had only just begun. We will deep dive into his rationale and explore what it means for us. According to Burry, the trends we've seen over the past 25 years indicate that the bottom of a current market crash is usually lower than before, and it's by about 10 to 15%. That's crazy. Michael Burry is anticipating a peak-to-trough fall of 61.4%, bringing us back to the historical standard Shiller PE of roughly 16. In contrast to where we are today, he anticipates a 50% drop in the stock market. It's a bold prediction, and not without criticism, with people calling him a perma-bear. Burry also said that historically, even in the worst times, statistics show that it is pretty common to see short-term solid recoveries among the longer-term downward trend. He is confident that we are in the early stages of a much bigger problem. To elaborate on his point, he further commented on our comparatively low trading volumes during the 2022 downturn. In Burry's view, we will see a lot more selling value coming over the next few years, leading to much more significant declines in the stock market. He is not looking forward to it. He saw this will happen all before. The first time through the dot-com bubble and the second time through 2008. He sees these repetitive patterns of human behavior time and time again. He has studied the greed and excess of the major booms and busts. Probably that is what gives him such confidence when he talks about these issues. He recently posted an eye-opening chart on his social media. We see a 10-year S&P run-up to today in white. In yellow, we see the run-up to the dot-com bubble, and in green, we see the run-up before the Great Depression. The graphs are freakishly similar. But this is all just the stock market. We must remember that the core reasoning behind Burry's perspective is, of course, the economy. With inflation, interest rates skyrocket. In harsh inflationary environments that bring about significant interest rate rises, unfortunately, consumers have less money to spend. More of their savings and income goes to servicing their debts. It frequently starts a negative spiral because less discretionary spending means fewer sales for the companies you are invested in. So ideally, you want the consumer to be breaking it in. And from where Burry is standing, the position of consumers doesn't look well. He worries about the depletion of savings because it pushes everyday people to use more credit cards in an environment of rising interest rates. So overall, we have inflation, peaking interest rates, reduction in consumer savings, and thus less discretionary spending, which ultimately leads to lower profitability of businesses. It's a vicious circle, and thus far, Burry thinks we are only in the first phase. What is your take on this insane position of the economy? Let us know in the comments below. We'll see you in the upcoming video with more such topics to explore. Till then, stay curious.